Many investors fear recessions more than almost anything else. Falling prices, alarming headlines, and uncertainty create emotional pressure that pushes people toward rushed decisions, even though these periods are a normal and recurring part of long-term market history. Market crashes feel sudden, but they rarely appear without warning. Economic slowdowns, tightening conditions, and shifts in confidence usually build quietly, testing whether investors are prepared mentally or simply reacting to events as they unfold. A calm approach to recessions begins with acceptance. Economic cycles are unavoidable, and attempting to escape them entirely often leads to worse outcomes than enduring them with discipline and patience. Fear during downturns often comes from short time horizons. When investors focus on months instead of years, temporary declines feel permanent, even though history shows recovery is a repeated feature of markets. Recessions reveal how investors truly think about risk. Price volatility feels dangerous, but the deeper danger often lies in abandoning sound principles under emotional stress. Market crashes expose behavior more than intelligence. Knowledge matters, but emotional control determines whether that knowledge is applied or ignored when it matters most. During downturns, many investors confuse uncertainty with permanent loss. This confusion leads to selling assets at the moment when future returns are often becoming more attractive. A disciplined mindset views falling prices differently. Lower prices do not automatically signal failure, but instead require reassessment of long-term business strength and staying power. Recessions test patience in uncomfortable ways. Progress slows, confidence weakens, and waiting feels unproductive, even though time is often doing the most important work behind the scenes. One consistent principle is preparation before crises occur. Clear rules and long-term thinking matter most when emotions attempt to override them. Market crashes remind investors that optimism and pessimism both overshoot. Extreme fear rarely reflects long-term reality, just as extreme confidence often ignores underlying risk. Understanding personal temperament becomes critical during recessions. Knowing how much volatility you can emotionally handle prevents decisions that feel logical but become overwhelming in practice. Downturns expose the cost of leverage. Borrowed money amplifies stress and removes flexibility, often forcing action at precisely the wrong moment. Recessions also highlight the importance of liquidity. Having financial buffers reduces pressure and allows decisions to be made calmly instead of from desperation. A long-term perspective reframes recessions as periods of adjustment rather than catastrophe. Economic systems adapt, businesses evolve, and markets eventually reflect those changes. During crashes, many investors seek certainty. Unfortunately, certainty rarely appears when it is most desired, making acceptance of ambiguity a necessary skill. Staying invested during downturns does not mean ignoring reality. It means continuously reassessing fundamentals while resisting emotional reactions to temporary price movements. Recessions reward those who separate noise from substance. Headlines grow louder, but underlying business performance changes far more slowly. Market crashes test conviction. Owning assets without understanding them increases anxiety, while understanding creates resilience during uncertainty. Another lesson from downturns is humility. Markets remind investors that control is limited and outcomes cannot be perfectly predicted. Recessions also expose opportunity cost. Capital tied up in weak positions limits the ability to respond when truly attractive opportunities appear. A calm approach emphasizes survival first. Avoiding permanent loss allows investors to remain in the game long enough for recovery to occur. Market crashes are painful, but they also reset expectations. Lower expectations reduce pressure and allow disciplined thinking to return. Recessions reveal the difference between speculation and investment. Speculation depends on favorable conditions, while investment depends on durability. During downturns, impatience becomes expensive. Acting too quickly often locks in losses that time could have repaired. Emotional awareness becomes a critical tool. Recognizing fear as a feeling rather than a command prevents it from dictating decisions. Recessions test whether strategies are truly long-term or merely optimistic during good times. Stress reveals hidden weaknesses in planning. Market crashes punish overconfidence. Assumptions made during stable periods often fail when conditions change. A disciplined mindset treats downturns as stress tests. They reveal which ideas were robust and which depended on perfect conditions. Recessions also reinforce the importance of simplicity. Complex strategies are harder to maintain when clarity is most needed. Avoiding constant information intake helps during crashes. Less noise creates space for rational evaluation instead of emotional overload. Market downturns often create regret. Investors replay past decisions, but focusing backward rarely improves future outcomes. Recessions reward those who prepared psychologically. Emotional readiness often matters more than analytical brilliance during stress. Periods of decline highlight the value of diversification. Concentration without understanding increases anxiety when prices fall together. Recessions remind investors that markets do not move in straight lines. Progress often includes long periods of stagnation and decline. Market crashes challenge trust in the process. Staying committed requires confidence in principles, not in short-term results. Downturns expose unrealistic expectations. Adjusting expectations reduces frustration and supports better long-term behavior. A key lesson is that doing nothing is often an active decision. Waiting preserves capital and clarity when action offers no advantage. Recessions test emotional endurance. Holding through uncertainty requires accepting discomfort without constantly seeking reassurance. Market crashes highlight the importance of review. Honest reflection strengthens future decisions more than defensive justification. Periods of decline reward patience unevenly. Those who endure quietly often benefit later, while reactive behavior compounds damage. Recessions also reinforce the danger of comparison. Watching others panic or speculate increases pressure to abandon personal plans. Downturns remind investors that markets are not designed to be comfortable. Discomfort is the price of long-term returns. A resilient mindset focuses on process rather than prediction. Processes survive uncertainty better than forecasts. Market crashes often feel endless while happening. Perspective comes only with time, reinforcing the importance of staying grounded. Recessions reward emotional discipline. Calm behavior during stress preserves optionality and future opportunity. Downturns emphasize the importance of financial alignment. Investments should match temperament, not theoretical ideals. Market crashes challenge narratives. Stories that felt convincing during growth periods often fail when conditions reverse. Recessions test flexibility. The ability to adapt without abandoning core principles is a valuable skill. A calm approach avoids heroic decisions. Dramatic actions feel satisfying, but often create lasting harm. Downturns highlight the role of confidence built on preparation. Preparation replaces panic when uncertainty rises. Market crashes teach restraint. Saying no to unnecessary action preserves clarity and reduces regret. Recessions remind investors that recovery is uneven. Patience must extend beyond headlines and early rebounds. Periods of decline strengthen disciplined habits. Repeated, calm decisions build resilience across cycles. Market crashes reinforce the value of long-term ownership. Businesses, not prices, ultimately determine outcomes. Recessions reduce illusions of control. Accepting limits encourages focus on what can be managed, behavior, and process. Downturns expose emotional triggers. Awareness of these triggers prevents repeated mistakes. Market crashes remind investors that survival precedes success. Remaining invested matters more than perfect timing. Recessions teach that confidence should come from understanding, not optimism. Understanding endures when hope fades. Downturns clarify priorities. Long-term goals regain importance as short-term excitement disappears. Market crashes reward those who stay steady. Calm behavior compounds quietly while chaos consumes attention elsewhere. Recessions show that time is the greatest ally. Time absorbs shocks that emotion cannot. Periods of decline reinforce the importance of staying rational when others cannot. Market crashes ultimately test behavior, not intelligence. Discipline determines outcomes when conditions are hardest. Recessions remind investors that patience is not passive. It is an active commitment to long-term thinking. Downturns confirm a timeless idea often associated with Warren Buffett. Markets test temperament before rewarding capital. In the end, recessions and crashes are unavoidable teachers. Those who remain calm, disciplined, and patient allow long-term investing to work as intended.